have with us Ajay Tyagi, Head of Equities of UTI Asset Management, joining in. Hi Ajay, good morning. Thanks for taking the time out to talk to us. It's Samina joining you from NDTV Profit. Ajay, just taking a cue from the sort of listing some of these primary market or newbies on D Street have got. What are your thoughts? Do you feel like with the amount of listing that we've been seeing in the last couple of months, potentially could be or has been the reason of liquidity getting squeezed out of the broader markets?
So yeah, good morning. I would say, liquidity is still abundant in the marketplace. We are seeing flows both by way of mutual funds, SIPs, and lump sum. And the good news is that even FIs have turned positive now. So yeah, I mean, I don't think that there is any lack of liquidity, but at some stage there would be fatigue that will catch up. The valuations for the markets have only been inching up. Of course, earnings growth has been coming, but at some stage there will have to be a convergence between earnings multiple and earnings themselves. And I think that could be the reason for fatigue. Maybe we have started seeing that fatigue in a few sectors already. Some bit of liquidity is being channelized into new IPOs. Now that also at some stage reverses, because if the quality of these new IPOs is not up to the mark, which is only visible after a few quarters of listing, then you could see a lack of excitement on that side of the market as well. So in general, I would say that liquidity remains strong, but we can't take our eyeballs off valuations. Yeah.
Completely agree, Ajay. In fact, we've been complaining about valuations from the end of last year, and there's been no letting up in that sense. Just coming back to the IPO space before I move on to the secondary markets, do you feel like the IPO market, though, is in a bubble? I mean, the BSE SME IPO index has given 160% returns in the last year, and that comes in at a PE of 65. Every single IPO we've seen has been oversubscribed at least 100 times. Do you feel like the space is exploding and this could be a bit of a concern?
Yeah, without mincing words, I would say that it certainly is a cause of concern, especially the SME IPO market. I think that's the market where you hardly see any institutional participation. That's where the retail part of the market gets completely agog, and without necessary checks and balances, things very easily go overboard there, and that's what we've been seeing right now. So SME IPO clearly case for concern. As far as the main market is concerned, I would say, yeah, here also one needs to exercise caution. Now, there's a good part of this story and a bad part. The good part of the story is that, look, India is one of the very few markets where such kind of high quality IPOs keep coming by. The other day I was reading data around the UK markets, and it's a very sorry state there, because in the UK over the last 2-3 years, there have hardly been any IPOs, and therefore domestic investors are frustrated in terms of where to put in, incremental money. India, to that extent, is quite blessed. But see, there is a 80-20 Pareto law everywhere in life, and that's true for IPOs as well. So if you're getting 100 IPOs, please bear in mind that 80 of these IPOs will not create wealth for you in the fullness of time. They may give you listing gains, but they may not, essentially be those wealth creating companies. So you have to be extremely focused when you do research. And eventually, yes, some of these companies will turn out to be great businesses to hold. The onus of doing the right research and picking up these gems lies on the investor. So, yeah, I mean, good part is we have a very good funnel, but we have to still, distill that funnel and take out companies which are really worthy of, being held for the long term. Yeah.
Ajay, you started this conversation and we both concluded that valuations are stretched, but liquidity is in abundance. In that sort of a backdrop, do you see a low probability of a deeper correction in the equity markets in the coming quarters, even if earnings disappoint?
That's a very difficult question to answer. And with each passing year that I have spent in the markets, the one thing that I've learned is that, markets basically prove you wrong all the time. So, my 25 years of experience in the markets tells me that it's very, very difficult to forecast how this creature would behave over the next 6 to 12 months. You're absolutely right. If you would have asked me this question about are markets expensive, then exactly 12 months back, I would have said, yeah, they are expensive. And look here, we are sitting at this market which continues to make new highs every other month. But yes, our concerns really remain around valuation. The big picture remains solid. India is tracking well on most macroeconomic vectors, and investment is also a bit of a relative game when India gets compared to many other emerging markets around us, not just geographically but in the same universe. uh, India really stands out as one of those oases where you continue to see growth, and growth being steady for decades to come. So yeah, there's a short term and the long term. I would say in the short term, the probability of a correction to our mind is higher. And please don't miss out on the fact that a bull market itself comprises of many corrections. So, this is nobody's case to say that in a 5 year or a 10-year bull market, you won't see corrections. I'm just reminded of this 2003 to 2010 bull market, where there were at least three very, very strong corrections along the way, while earnings growth remained strong. So, to your point, if earnings growth surprises us on the positive side, does it mean that we would barely have a correction? I would say no, that wasn't the case in the previous super bull market that we saw. That hasn't been the case in global markets as well, whether in US or in Japan. Whenever things go a little overboard, a collection is always lurking around the corner. Yeah.
Ajay, do you believe that focusing on quality over momentum may be a better strategy from here on? And I ask you this because one of the top performing funds in the recent past has been from your stable. The UTI Momentum has caught everyone by surprise. I mean, the outperformance has been significant. Do you feel that from now on, the bet should be on quality as opposed to momentum?
Yeah, again, that's a brilliant question. We've been grappling with this, and as I said in the previous question, it's almost impossible to time these things. So, you can only look at the data and figure out where are you in the cycle, and you can never actually forecast and say that, look, this is the turning point, and therefore we must switch the tap from on this one and open the tap on the other one. So that it never happens like that. But yes, the charts are telling us that we are very deep into the momentum cycle already, and at the same time, we are actually at a very, very initial stages of the quality cycle starting to look north. And if you look at data which goes all the way to 2005, because thankfully we do have data for the momentum factor, the value factor, and the quality factor from 2005, and we follow the cycles over the last 20 years, then the data is suggesting that we are certainly at the cusp of quality turning around and starting to surprise. At the same time, momentum actually going into a consolidation, taking a breather, perhaps even correcting. So yeah, I mean, I would agree with that analysis of yours. We too are reaching to the same conclusion.
It's a tough market for any fund manager to navigate right now. The other question on the same lines, there's so much of talk about moving to the large cap space, and you alluded to the fact that a lot of the FI money has started coming back. Now, part of it on Friday was largely on back of the rebalancing of the FTSE index, the World FTSE index. But that aside, if we do believe that we've borrowed returns from the future because the Nifty has been outperforming year to date, the idea that passive large cap would be enough to play that space may not stand. Do you think now is a good time to play the large cap space and do it through active fund managers? Because up until now, their performance wasn't even beating the benchmark.
Sure. See, in any market which is extremely polarized, you would find active fund managers finding it very difficult to beat the benchmark. So, let's take the case of the US markets as well. If there were those magnificent seven stocks which were actually, surprising everyone month on month, both fundamentally and therefore in terms of their stock prices, it would have been well impossible for any fund manager running a diversified fund to beat the respective benchmarks. And so has been the case in India. The market has been fairly polarized, and therefore ability to beat the benchmark is very low. But our view is that the markets may actually consolidate over the next 12 months. They may even see a correction, and it is during times like these that active fund managers basically have a higher ability and a higher probability to beat the benchmark. So yeah, I mean, I would say that the next 12 months look to be loaded more in favor of active managers. The last 2 3 years have pretty much been the case of anything and everything going up. It would be much more selective from here on. I think a lot of these businesses which were badly beaten up in 2020 saw a very sharp fall from their respective abyss. That's gone. So that price movement, that very sharp price reversal and movement is now gone. From here on, like I mentioned earlier, it ought to be a convergence between earnings and valuation. And wherever managers are able to figure out businesses which would have a much better earnings profile over the coming years, I would say the rewards should ideally be waiting for them there. Yeah.
Ajay, there are two sectors, both global facing. Tech, usually in a lower rate cycle, tends to outperform. And it's also one sector that over the last decade has given investors positive returns. The last few weeks have been rough for IT stocks. On the contrary, metals, where fundamentally things are concerning, but just because the Fed cut rates in China today, of course, lowered rates and pushed in some liquidity, metal stocks seem to be up and about. Also, the fact that LME inventory stands the record low. How do you play both these global facing sectors? Do you buy into IT on reasonable valuations? Do you buy into metals despite weak fundamentals? What is the bias?
Sure. See, there is always this question of the very near term versus the longer term. Now, these two sectors that you mentioned, one of them, which is IT and tech, is basically a structural growth industry. I mean, we can keep debating for hours and hours together about how technology has shaped our lives, how technology has shaped businesses, how technology from just being a cost saving tool for corporates around the world has metamorphosed into a customer acquisition strategy. So now, if two companies are wanting to win the battle and get the best customers and witness growth, then technology is a very big facet of this because technology provides that interface. And if the interface is really great, then customers typically gravitate towards these businesses. So I think technology is into structural growth. We started seeing the fruits of technology in the late 70s and 80s. It's continued for 4 decades, and I won't be surprised if it continues for another couple of decades at least. But yes, there will be cycles, like you mentioned. There was a weak cycle in 2022 and 23. We may be getting into an up cycle right now. I'm sorry. And from that perspective, most IT companies look attractive. Of course, they are overvalued compared to the historical past, but the overall markets are at least 20 to 30% overvalued compared to the last 10-year history. So to that extent, the overvaluation for the IT sector is not that significant. The other one is metals. This is highly cyclical, of course, as we all know. And of course, in the near term, there could be an element of Fed rate cuts. There could be an element of stimulus coming in from China. But if we all are of the opinion that global growth is slowing down, certainly in China and also in the US, even if US avoids a recession and goes into a soft landing, the growth in US would be a fraction of what it was between 2021 to 23. Europe itself is showing no signs of strength in any case. So from that perspective, I'm wondering where would the demand-led pull come for this entire metal space. So outside of this technical factor, from a medium-term perspective, the picture is not really that rosy for the commodity space. Yeah.
Also, one space, and if it's more domestic facing, even though we aren't seeing too much activity in this space over the last few days, is consumption. Are you buying into the consumption cycle right now? Because there's so much that's happening for us. There's a general sense that earnings will also see an improvement from this quarter on. We're going into the festive season. Consumption a place you like? And if yes, what would the bet be? Would it be urban consumption? Would it be rural? Would it be aspirational? Would it be QSR? Any sort of biases there? And if whether you're constructive and overweight on it to begin with?
Absolutely, we are overweight on consumption, and let me make a very profound statement. You can't be positive on India and yet be negative on consumption. we are an economy which is driven by consumption. Almost 70% of our GDP comprises of domestic consumption. So you can't be positive on India structurally and say that, look, what I don't like about India is India's consumption. Yes, consumption goes through its own cycles. We've seen that high inflation of 2022 and 23 led to pressure on the wallets for most households in India. And because of that, yes, the discretionary part of the consumption got curtailed. It did spill over to some bit of non-discretionary consumption as well. But thankfully, inflation is coming down. We see better, real earnings and savings for households going forward. Therefore, consumption should pick up. That's point number one. As far as biases are concerned, I would say rather than rural or urban, we try to dissect the consumption space into consumer staples, consumer durables, and consumer services. It's our belief, looking at data, that consumer staples would be that part of the market which should actually see the most anemic growth in the coming not only year or two, but even beyond that, for the simple reason that the penetration in this category has already reached to a very high level. And beyond the point, you can't consume, more shampoos or toothpaste or soaps and so on. So you can go on the premiumization curve there, but the volume-led penetration growth doesn't happen beyond the point. So India has already reached to a stage where the staples penetration is fairly good. But the penetration on the consumer durable side, which are many discretionary items that we use in the household, as well as consumer services, you were alluding to QSRs, which is a part of consumer services. I think this is where the consumer wallet will shift. This is where we will see households and consumers making incremental spending. And that's the part where the penetration, by the way, is very, very low, not only compared to the global averages, but even compared to emerging market averages. So I think that's the, if I may use the word, that's the predilection that we have within the consumer space. Yeah.
You know, Ajay, another way to play consumption and to play new energy is through the auto space or through the auto ancillary space. Again, we're going into the festive season. How do you feel the auto sector can be played? One, would you buy into auto companies? If yes, where would the biases be? Or would you just play the auto pack by simply playing the ANKs?
No, I mean, we would actually try and find out great businesses in all corners of the auto space. So it's not as if we are, at this stage limited only to passenger cars, not to two-wheelers, or only to ancillaries, and not to OEs. So I think there are strong businesses in all quarters within auto. The good news about auto is that whether we look at passenger cars, whether we look at two-wheelers, and also at ancillaries, which are, by the way, supplying either to these domestic OEs or exporting. I think there is immense scope in the coming years, and I would say beyond the next few years as well. So it's basically very, very linked. It's highly linked to the valuations within this sector. Parts of this sector have seen a massive valuation run up. So from a near-term perspective, we would be cautious on those. And some part of the sector has actually not participated as much, and valuations here are extremely comforting. While the markets are trading at, like I mentioned earlier, 30% higher than their last 10-year valuations. Within the auto space, there are a few players which are trading around their long-term valuation. So, yeah, I think our focus would be basically on such companies. But auto in general remains a fairly, I would say, longer term, long runway industry opportunity. Yeah.
Ajay, you know, you said if you want to play India, you cannot not play consumption. I would extend that further and say if you want to play India, you can't not play the financial sector. Now, so many different verticals to play the financial space, right? You can either go with banks, you can break the banks into private and PSU banks. You can then, of course, bring in asset management companies. You can bring in companies that are focusing on wealth, so maybe the Edelweisses of the world, betting on the financialization of the country's savings. What is your bias in financials? Where would your bias say? And if it's banks, then is it private versus public? And if it's outside the banks, then what are the obvious choices you'd make?
So yeah, that's a great question. And I would say this is one of those sectors where there are immense opportunities within. So we are playing financialization of savings on one side. We are also playing basically credit penetration. And this credit penetration is both on the household side as well as SMEs and even large corporates. And we are obviously, playing this theme wherein, these banks are financing the consumption which households are undergoing. Whether you're buying a big LED TV or a refrigerator, I mean, it's all getting financed. So I think the opportunity here itself is immense. Now, what's happened in the last few years is that, the plays which are related to the capital markets in one form or the other have seen a very sharp run up. Of course, because of very strong earnings growth over the last 3-4 years, and also because of a massive re-rating in their valuation multiple. So it's been on both accounts. Now, should earnings take a breather if, let's say, capital markets go sideways, for a few quarters or a couple of years, or they don't, have the kind of momentum that I've experienced in the last couple of years, then there would be, earnings slowdown, which will also lead to derating. So I think this is the part of the market where we would be cautious at this stage. It is still an opportunity in the fullness of time, but from a very near-term perspective, I think it's better to be cautious here because both earnings and valuation re-rating has been in their favor over the last few years. The exact opposite of this has been private sector banks, which have barely participated in the rally, and it really baffles most of us here because we are really talking about some of the best managed institutions in this country. And I'm not saying best managed banks or NBFCs. I'm saying some of the best managed corporates in this country are pretty much the companies which have not participated in the rally for the last 3 years. Of course, there have been near-term concerns, but there is no real longer-term concern which should pull them back. So from that perspective, that's the segment we remain most positive on at this stage within banking and financial services. Yeah.
Ajay, in terms of a portfolio construct, and I know coming from an asset management company, you would be recommending individuals to follow a strict rule of SIPs or STPs, and we all agree that it's time in the markets, not timing the markets. But if I had to just, bring this down on a very pointed way, would you recommend investors to stay on the sidelines with incremental addition to the markets, hoping that there could be a better opportunity? Because you did indicate that you do see the year to be one of consolidation or maybe even some correction. So would it be wise to sit on some cash? And if yes, what quantum would you advise them to sit on in terms of percentage for an average risk profile investor?
Sure. So, see, that's a very, very difficult question to answer, to be honest. I did say that it's impossible to, figure out the direction of this creature over the near term. And therefore, to make any such kind of, I would say, advice about how much cash to hold, how much to invest is always fraught with that risk of markets surprising you one way or the other. But all that we are saying right now is that, from a big picture perspective, this is not the time to be making lump sum investments. This is not the time to be actually feeling, having this feeling of missing out or having missed out the rally of the last 2 years and therefore now playing catch up by making one, big investment into the markets at this stage. So, for investors who have either missed out or investors who participated in this rally, going forward, at least for the next 12 months, the most rational thing to do is to make SIPs on a monthly basis. Should markets correct, you should be happy because your investments are being made at lower levels. Should markets refuse to correct and stay where they are or even inch up, at least you won't have that regret of staying outside of the market. So the only rational, and see, investing, as they all say, is majorly a behavioral science rather than knowing deep about your company. So it's your behavior which ought to be in the right place. So from a behavioral perspective, I think it's our advice to continue participating in the markets by way of SIPs. Yeah.
Ajay, one quick one on chemicals. There seems to be some sort of a rebound that's playing out, and after many years of underperformance, I mean, this was a sector that was a darling of D Street for such a long time, right? And then came the overcapacity, then came the concerns on demand. But it feels like the situation may be improving. Are you bottom fishing in the chemical space? Are any of your fund managers optimistic on chemicals?
So without going into the specifics, I would say that the chemical industry did come out of a massive. I'm not even sure whether it's come out completely, but has undergone a massive destocking over the last 2 years. And that's the reason why many chemical companies, I mean, I would say most chemical companies in India did face, growth pressures and also did face margin pressures. But we seem to be coming close to this destocking cycle. And at some stage, the industry will start to see restocking once again, which would mean that the growth engine starts for most of these chemical companies from India. So yeah, I mean, we too have been watching this cycle over the last couple of years. We seem more confident today compared to a couple of years back. Uh, and yeah, I mean, we would be selective in this industry.
Right, thank you very much, Ajay. We'd have loved to chat with you longer, but on to other news stories that we have to track. You have a good day, and we'll hopefully see you soon.
Thank you. Thank you. Good day too.
With that, we're completely out of time on this edition of Talking Point. Thanks for watching.